Hi there, my name is Arnu and I'm the macro strategist for Financial Source. Now, a question that I get asked a lot in our analyst desk is whether there's any shortcuts for being able to track where the US economy is headed. Now, for those of you who don't know, we trade with macro fundamentals, which means we track and follow many different economic data points every week. But not everyone will have the time to do what we do. Some traders might be more limited with their time. So is there a shortcut that we can use to track where the US economy might be headed? Yes, there is. But before we get there, let's first discuss why you would want to do that in the first place. The reason for that is because the US is the biggest economy in the world, meaning it's a key driver for the global economy. Also remember that monetary policy settings from the Federal Reserve doesn't just impact the US economy, but also impacts the whole global economy. So having a shortcut to broadly gauge where the US economy is headed can give us a really good sense of where we are from a cyclical perspective. And knowing that will give us a pretty good idea of the bias for major asset classes. So knowing where the US economy goes and thus where the Fed should take policy is important for various asset classes: fixed income, FX, equities, and commodities. Now, let me start by saying that we track many different economic data. Many data points. So using a shortcut version will never be able to give you a detailed view of the economy. However, it should be enough for a general overview. Now, this shortcut we'll show you is built on the shoulders of many other analysts who have used a very specific leading economic indicator framework for tracking big changes in the US economy. The one I'll show you now has a lot of inspiration, especially from the team at Piper Sandler. Now, when trying to track any economy, it starts with knowing what signals we are getting from the leading economic indicators, of which there are many. However, it also helps to know which of the leading indicators tends to lead and lag the others. The first place to start for the US economy is the housing market. The housing market is so important to watch. And the best indicators to use to track for the housing market is the NAHB Housing Index and the new home sales. In this chart, we have the 3-month average of the year-over-year growth rate to strip out the noise. The sentiment from home builders and the actual level of new home sales gives us very important clues about the overall economy. Notice how both of these two indicators lead into both recessions and recoveries. Also notice how big swings in both of these two measures often coincided with big swings in the year-over-year returns of the S&P 500. So why are home builders' sentiment and new home sales so important? Well, because new homes have a large transmission effect throughout the major economy. To build a new house, it needs consumers to feel confident enough about the future. It needs financial services, legal services, manufacturing services and work, all of which impacts employment. It also impacts things like durable goods spending and raw materials. The reason why I like to include both these two indicators under housing is because I find both together gives me a cleaner read of the overall housing market. After housing, we need to watch the consumer. You see, once the housing market has started to deteriorate, we would expect consumer sentiment to follow or coincide that move in the housing market. In this chart, again, we have the 3-month average of the year-over-year growth rate to strip out the noise. Given that the US GDP is close to 70% consumer spending, the sentiment of consumers matters greatly. It matters for how they spend in the economy and is usually a good leading indicator to turn after or alongside the housing market when their sentiment changes. Also notice how big swings in consumer sentiment usually leads the S&P 500 year-over-year returns into recessions and usually coincides or leads the bottoms as well. After that, the next part of the economy we expect to turn is overall economic activity. And there's no better indicators to use for that than the ISM manufacturing and non-manufacturing PMIs. In this chart, once again, we've used the 3-month average of the year-over-year growth rate to strip out the noise. Now, there are many things to like about the US ISM indexes. For this example, we use the headline indexes, but the sub-indexes provide so much detail as well. We get info on new orders, which is a good leading indicator for production. We get info on prices paid, which is a good input for future price pressures. And we get info on employment, which is a good leading indicator for future labor market changes. Now once again, notice how big swings in the ISM composite, which is just a weighted composite of both manufacturing and services, how it leads both recessions and recoveries. So then after housing have turned, consumer sentiment has turned, and overall business activity has turned, then we turn our attention to the labor market. The labor market is a lagging economic indicator, so we expect things like the unemployment rate to take some time to turn and reflect the changes that we've seen in the other three mentioned areas. However, the labor market also has leading indicators. We mentioned these sub-indexes in the PMIs, which are helpful, but the other one to always watch is initial jobless claims. In this chart, once again, we've used the 3-month average of the year-over-year growth rate. Now notice, even though the unemployment rate lags into a recession and out of a recovery, initial claims actually leads in both cases. With these four, we have a really good read of where the overall US economy is expected to go. So to recap, housing first, then sentiment, then business activity, and then labor. If you don't have the time to track all the important economic data, at least with these four, it gives you a really good overview for where the US economy might be headed. And that's important as it'll give you a general idea of where monetary policy will be going as well. Now keep in mind, just because these indicators are great to track for the economy doesn't always mean that the markets will think they are important though. Even though they are very useful, markets actually don't pay that much attention, apart from of course the PMI releases. Well, that is at least until we get really close to a recession or really close to a recovery, and then all of a sudden the market's attention will jump as these events play out. So that's it for this video. I hope this framework will work for you as well as it has worked for me. Any questions on this, as always, don't hesitate to let me know. As always, happy trading.